Hello and thank you for joining me. I'm Jerry Sarmiento from beautiful Northwest Houston, Texas. And today is Sunday, March 28, 2021, and it is 6:07 p.m. So it's happy hour time. Cheers. It's nothing like a good old fashioned. Anyway, today the market is closed, so it's a good opportunity to talk about what's going on in the market. A lot of my trader colleagues are very frustrated with what's going on. One day the market opens and it goes up and then goes down and it goes up again, it goes down again. It's a ping pong thing going back and forth, very frustrating for many traders that are trying to figure out what the heck is going on. So I'm going to try to explain here what I think is going on. Of course, I'm not a financial advisor, I'm not a guru, and I'm by no means I can predict the future. So I'm just basically looking at history and looking at probabilities and trying to explain the best I can what I believe is going on in the market. This is the view of the Standard Poor's that goes back to ever. Let me get my picture out of here a little bit so you can see. This goes all the way to, my gosh, the history of the Standard Poor's from the beginning of time. And as you can, let me get rid of this pen. As you can see, all the way from ever, the S&P price. And by the way, this is a monthly chart. This is not a daily or a weekly. This is a monthly chart. So give you a good perspective as to historically what has been going on with the Standard Poor's. The S&P, and this is the SPX. The S&P price has been pretty much trading along its 20-day moving average. That teal line, bluish line, is the 20 moving average on the monthly chart. And as you can see, it has always been pegged basically to the 20. Anytime it moves away, it comes back to it. Moves away, comes back to it. Moves away, comes back to it. Breaks down. This was in, when is this? 2000, 2001. It broke below and it tried to return. It kept breaking down and it came back to the 20. Broke down further, tried to come back and finally came back, and I started to trade just around the 20. Same thing here. This is the famous 2009 time, the big crash, and it's always been like that. It brings us to more recent times where we are now. This is, let me take my glasses off. It's hard to see the charts with glasses on. This is, as I was saying before, 2009, a big break under the 20 moving average, and then it's returned back, and then trading around here. This is our 2016, and then later this 2019, and this is, let me get me out of the way here. This is, of course, what we just experienced in this December, January of 2020. January was overextended from the 20 moving average. It broke down hard. That was the pandemia, the COVID-19 virus effects on the economy and on the stock market. It broke down really hard and it came back up to the 20 again. So the history I'm trying to explain here is that this thing called the S&P, which is a whole collection of stocks, has been trading near its 20 moving average on the monthly chart, and it always, when it ever extends away from it, it comes back to it, extends away to it, comes back to it, extends on the below side and comes back above to hit the 20 again. And what we're seeing right now is a major extension. Let me see if I can measure from let me see, this is the 20 moving average to the closing of the month, which you were pretty close to closing the month anyway. We're in the last days of March. It is at 21.62% overextension from the 20 to the closing. That is a lot, my friends. That is quite a lot. If you look at the extension here was from the 20 to the closing of that month, it's 14.15, and that month of course was August. Okay, and you can measure everything else that you want here. You come from the moving average back up to the closing of that month is 15.8. So 15.8, around here was 15 something, I don't remember what it was, but it has never been this huge. This is huge. This is, as I said before, around, now it's 1776. Let me see, did I measure it correctly this time? 17.6, 17.7%. But it is huge. It's a big extension from the 20. So what I see here is two possibilities. Okay, one is a furious and fast and vicious breakdown to try to come back to the 20, like we did here with the COVID thing, and they actually not only touched the 20, but it broke it and went below, and then it came back up. So I can see both either a vicious, fast, and furious breakdown to touch the 20, or a very slow and painful kind of a death by 1,000 paper cuts of this thing moving sideways and correcting by time. Correcting by time meaning that it's going to keep moving sideways, waiting for the 20 to eventually catch up with it. So that's what I'm seeing. I don't see, and again, I'm not predicting the future, and I'm not an expert or a guru, but just based on this history of a century of history of the stock market moving away from the 20 and coming back to it, it tells me that this thing has to go back somehow. I don't know if it's going to come down fast and furious, as I said, or if it's going to keep moving sideways, waiting for the 20 moving average to catch up with it. So that is basically what I see. If you go to now to the daily, let me see, what is the daily? That's a 2-year, 1-day view. This is what we've been experiencing recently, the painful moves sideways here on a intraday basis, moving up and moving down and if things turn out to be like what I think is gonna be, like correcting by time, or meaning moving sideways for a long time, this painful period is going to continue for us. So no need to be frustrated, you just need to know what the hell is going on and be prepared to scalp if you're an intraday trader. Scalping is going to be something that you need to master, because you're going to need to get in and out quickly. Swing trading is going to be difficult to do unless the thing really breaks up. This is daily view again. If the thing, if we're right at the all-time highs right now, if it breaks up, things could get better. But how could it break up if what we're seeing is this major overextension? Of course, the market is different today in 2021 than it was in 2019, than it was in 2008, 2001, 1999. So it's a different market. Maybe the rules of gravity have changed. I don't know. We will find out. Let's look at the Nasdaq NDX, and this is the monthly view. basically same thing. Look at that. This major consolidation right in the last 3 months in this range here, and red candles. I don't know if that means that this guy is about to break down or he's gonna continue sideways, waiting for this to catch up. But the overextension from the 20 is major. Look, from the 20 moving average to the closing of this month of March of 2021 is 21.21%. Let's say 20%. 20% is a big number. It is a very big number to be overextended from its 20 moving average, and the history of the Nasdaq is about the same as the standard S&P, which is pegged to its 20 moving average forever, for the history of mankind as we know it. So the fact that this overextended here, it gives me caution and makes me trade on an intraday basis using scalping techniques. Get in and get out quick, catch your profits, get out quick, and be very, very careful with your swings. Anything my swings is my different view. Is I look at the daily, and if anything is under this 10 moving average, then I get out of the way. If it's above and riding on the 10, we are good. We continue going. But these are different times, my friends, and there's no need to be frustrated or scared. You just need to know what's going on. Again, this is my view, and hopefully is of value to you in thinking what you're going to do next week and next month and the rest of this year. So on that note, I'm going to continue my Sunday and enjoy. It's not a beautiful day today in northwest Houston, but the temperature is high. We're in the high 70s. It's not sunny today, which is strange, but I'll enjoy the day anyway. Cheers, and see you next time.